All right, everybody. So this bonus session, we're going to be focusing on underwriting, how I look at deals. If you have any other specific questions, make sure you put in the chat or you can come off mute, raise your little virtual hand. In this spreadsheet, you can see I already have this loaded up from before. This is a 24-unit deal that I have off market. This is actually in the Facebook group, by the way. You can download this spreadsheet. You can go through everything. If you have any questions on it, feel free to ask. This is a very, very high level spreadsheet. So again, if there's a lot of terms that you are not familiar with, just understand that it's okay to ask questions, and also Google is your best friend. So feel free to Google some terms, or maybe if you have not seen it. This spreadsheet I actually had built out. This was built out by a friend of mine who is a commercial lender who uses this to underwrite deals with clients. So that's how this was originally built out. We're going to dive into a couple of these key things. So first and foremost, this side here is the current. This is the current situation of the property, right? This is the current income of the property on this side, on the left-hand side here. You're going to see that I plugged in at the bottom here the current rent roll. You can see all this brings in currently $576,000 a year. $48,000 a month. Now, don't get me wrong, you guys can play with these types of numbers in the center here. I tried to break down the only parts that you actually need. Yeah, everything in yellow is what you fill in. Long story short, anyways, you can see this is where you put the current income, which is 576,000, which we'll plug into over here. You have vacancy, 5%. I try to keep that the same. Management's always 5%. And then you'll just enter in all the top information, the payroll, repairs and maintenance, and the reserves. That's all done automatically. You don't even need to change anything. It's just based off. By the way, this is an underwriting spreadsheet typically for multifamily. You can change some things on here to make it work for retail, but some of these things might be a little different. Obviously, it's not going to be based off of a unit number. Like if you have a strip center, it's not going to be based off of a unit number. So you're going to have to come up with your own numbers for payroll, repairs, maintenance, and reserves. If you look at this, it's $200 per unit for payroll, $750 per unit for repairs and maintenance, and the reserves is $300 per unit. Okay, this is exactly how a bank will underwrite the majority of multifamily properties. Again, vacancy, you're going to probably need to do 5% for the bank and 5% for management. Again, very, very common things for a bank to look at. You're going to want to plug in the exact for real estate taxes, insurance, water, water, sewer, gas, and electric. That's all the utilities. You want to be as accurate as possible. In this little section here, this breaks down really all of the actual numbers you're going to need to look at. So based off, this is the deal I was talking about. Seller's looking for 5.5 million. I pitched it to my investor at 5.8 because at 5.8, it is just about a 7 cap. And I know that this deal, he'll make sense of anything that's probably above a 7. That's like a true 7 cap. Like after all, true expenses here, like not buffering anything. Like this is like real true expenses. It's a 7 cap day one. So seller wants 5.5. I pitched this deal at 5.8 to the buyer. Remember, the purpose of a deal is to listen, you have to negotiate with the seller and you have to negotiate with the buyer so that you can have the most profitable transaction, right? Like, don't get me wrong. I'm not trying to get one over one on my buyer. Guess what? If a buyer's willing to pay X and a seller's willing to accept Y, who cares? They want to do a deal. I want to do a deal. And don't get me wrong. If they came back and said hey, I can only make 1% on this deal because that's how much room is in this deal. The seller's only willing to accept 5.45 and the buyer's only willing to pay 5.5 and I can only make barely 1%. Guess what? I'm going to barely make 1%. It just is what it is. But my intention is to try to make between 4 and 6% on every single deal. That only happens when I'm a good negotiator. Okay, so you have to negotiate the whole time. Now, again, this breaks down the entire deal. It says based on a $5.8 million asking price, the current cap rate is $5.4 million. Closing cost that is already calculated at roughly 4%. It's going to show you that based off of current purchase, it's a cash on cash return of 3.4. The loan amount you can see here, this is based off of a loan to value of 75%. So it's 25% down. There's no construction loan here. The debt yield you can see is a 9.93. Sorry, at 9.39. The debt coverage ratio, very important number to know that if it's not above 1.1, you're probably not going to get a loan on the property. Debt coverage ratio means based off of the income of the property, which is this number, the 408. This number, okay, needs to be at least 1.1. And I'd even say the goal is to get as close to 1.3 or higher. Okay, that means it's a good deal. That means there's a 30% margin above the debt payment. Okay, it's saying that at a proposed interest rate of 7.25%, the investor, the person who buys this deal, is going to be paying $356,000 a year in debt payments. This is the actual mortgage payment that they're going to make, principal and interest. Okay, so again, I want you to be understand that if this number is not, the goal is always 1.3. At 1.3, it's a great deal right now. That means you have the 30% margin to make some cash, right? That means that's going to be your cash flow. It means it's a heavy cash flow deal. At 1.1, it means there's only 15% in margin, okay, above the debt payment. And that's based off of $1.7 million down, which includes closing costs and the 25% down. My mortgage payment is going to be based off of the loan amount of $4.35 million. That's how I'm going to come up with that. Now, if I can get interest only debt at 7.25, I'm going to have a little bit more cash flow. Now, the other thing here is that this is the pro forma value, right? This is saying based on pro forma rent, which pro forma stands for what is the future possible income of the property. So it's like, okay, well, it brings in 576 today, and I think I can get the rents up to 625 within the next 12 months. I mean, this is only increasing rents by really like 3 to 5%. I mean, like not a lot. However, I think that in like another 5 or 10 years, I think we can get this rent up substantially. Now, if we can, this is the goal here. If we can pay $5.8 million today and we can get the income up over the next 5 years, that means if we can get the income up substantially over time, you can see this line here. This is already built out to show you the value of the property going up over time because the income is going up over time. And then after you refinance, you're going to be making, over 10% a year return on this deal. If the investor owns 100% of the deal and wants to make at least a 7% a year return, which is this is the estimated cash and cash that they're looking for day one, you can see that they're not going to make that. Like they're making 96,000 year one, they'll make 112,000 year two, so on and so forth. This is the cash on cash return, like the debt, the cash flow after the debt payments right here. That's what this line is. You can see this is the interesting thing. If in 5 years or so, after the income growing on this property by call it a couple percentage points. Point being that I'm trying to make here is that you can refinance the property at 75%, and you're going to be able to pull out $5.3 million. But if you waited, call it if you do 75% of 7.5 million, like this is the reason why people buy these types of big deals, and they look at long-term appreciation. 7.5 million times 0.75% is 5.62 million. So if they paid 5.5 million, they're going to be able to pull 100% of the money out of this deal. It'll be like doing a BRRRR, buy it, rehab it, rent it out, refinance. You're gonna be able to do that on a massive scale and pull nearly 100% of your money out in 5 years, which is great. But that's again because it's a good, this is a good cash flowing deal year one. Now, at the very, very bottom, I also specifically added a lot of the creative financing strategies. So like this is seller financing, this is debt mixing, which is like as an example, I want to do you can get a 70% loan and then the seller's going to seller finance the remaining amount. So you can basically get these deals for almost zero out of pocket if they can agree to some of these things. Again, I'm looking for interesting ways to get my cash and cash as high as possible. So what I found here, and I already did all the math for you. Like this will do everything for you. If you can get the seller to agree to seller financing, you can make a crazy return. If you get a 10% down seller financing deal at 6% interest. This is, I think, interest only payments down here, and this is with interest above here. This one looks like an interesting one where it's like, okay, well, if the seller will finance 50% of the down payment, or if the seller will finance 50%, and I have to come to the table with 50%, I can get a loan, a more normal mortgage, and I can get the seller to credit back 50% of the payment. At closing, I can basically have a decent, 7% cash and cash day one, but I mean, it's not really even a cash and cash. Cash and cash is infinite because I'm not having any cash at the table. And if you're wondering how these are done, I mean, this is very creative financing strategies. Again, if you have any questions about any of this, please feel free to raise your hand. You can ask the questions, but this will take a little bit of time to understand. It took me, 1 or 2 times to actually get how these work. But anyways, like this is how I underwrite a lot of deals. So like I'm looking for decent stuff that I can get between 7 and 8 minimum percent cash cap rates day one, right? With very conservative underwriting. It's like, think about it right now. It's like everyone's like, oh, well, again, I can't get deals done. Well, it's like the reason why I'm able to get deals done is because I find good deals. And if you find good deals are easy to sell, right? And by the way, is it easy to find good deals? Absolutely fucking not. Absolutely not. It is definitely not easy to find great deals in this market right now, but this is why you have the freaking pound the phones and try to get a lot more opportunities. Who's got some questions for me? I know this is like freaking drinking from a fire hose right now.
So I'm seeing that these are basically the questions, like you have the expenses there. I'm just thinking about like these are the questions I need to ask when I'm talking to potential sellers. And that way I'm able to just kind of input them into here and give them to my buyers.
Absolutely. Great takeaway. If you do not have all the information, it is very, very, very tough to underwrite a deal. It's very hard to understand how you should come in on listen, there's been times, okay, where my agents on my team do not understand this and they don't ask questions. And then they bring a deal to me like, oh, this deal doesn't make any sense. When they screwed up the underwriting massively and actually did make a lot of sense, and when they ended up losing a deal. This deal we got 7 months ago, and they brought me this deal and they had all the wrong information on it. So thankfully I was going through some follow-up and I called this guy and we're back on the table. Who's got another question for me?
I'm getting expense information from the sellers just verbally, and then I'm sending it to the buyers, and they're telling me that the expenses are way too low and there's no way that they could be that amount. Should I just be getting, like, I don't know how to combat that. Should I just get it from like the thing from them, the seller?
Yeah, so, okay, I'd say it like this. Typically, when a buyer is saying that the expenses are way too low, it's because you're not calculating a vacancy rate, you're not calculating a management, you're not calculating payroll, repairs and maintenance, and reserves. You're not calculating all of that because a bank is going to. When you're bringing a deal to an investor and you say like, hey, here's the taxes, the insurance, here's all the utility cost in which the seller is currently paying. Here's all the expenses that I have from the seller. Now, look, is there also a vacancy rate? Yes. There's also a management fee. Yes. Is there also going to be repairs and maintenance that need to be allocated for? Of course. Is there other expenses? Yes, of course, that has to be allocated. So if that's not there, the buyer's going to be like, well, what about all those expenses? The seller also cannot calculate a lot of this stuff. The seller's not going to mentally calculate vacancy rates. Well, this is how much money I've lost in vacancy. They have no fucking idea, right? So that's why we just take 5%. And by the way, do some sellers manage their own properties? Of course. Do all buyers manage their own properties? No. So you're probably going to want to calculate a management fee. Every loan that gets written, they're going to have to hold reserves. They're going to allocate for payroll on a building. It doesn't matter if it's a 5-family or a 500-unit building. They're going to allocate for repairs and maintenance. They're going to allocate for vacancy. They're going to allocate for management. They're going to allocate for payroll and like in reserves. Like they're going to allocate for these things. And if you do not allocate for it, they're going to. There's even like, again, I even have sometimes where like I'll have to add in to one of these lines that I have to add into marketing. There's a marketing cost on a much bigger property. I mean, even at this 24 unit, I should be allocating, it doesn't even have it. I should be allocating another $25 per unit per month for marketing, or $50 or $100 for marketing, because I have to market this property to get it rented, and you have to allocate that cost. And if you run all those numbers and the deal still comes out at a 7 cap, it's probably a decent deal. Because guys, listen, the old philosophy of really quick numbers in your head for a second, guys, is if the interest is higher than the cap rate, you're probably going to lose money, right? So like if your cap rate is 4% or seller wants 5%, like Mustafa, your guy wanted like a 5 cap, right? Like a 5.5 cap. And if debt today is 7% minimum, probably more, you're probably losing money day one. And instead of probably, you could probably put the word guaranteed to lose money, right? Like, so like, as an example, let's just say the debt on this was 9%. Interest isn't 9%, but this is an exact example of hypothetically if this was a 5 cap deal and the interest rate was 7. It's the same exact type of numbers, but I'm just trying to give you an idea of the debt coverage ratio means based off of a debt payment, okay? The annual debt payment is less right here. The annual PMI, principal and interest payment. If the debt payments are more than your net operating income, your debt payment is 420 and your net operating income is 408. That means you, sir, are going to lose money, which is why it's like, think about it. This is a lot of realtors will take this deal just like this. Again, it's not a 9% interest, but again, let's just say this is a 5 cap deal and debt is 7%. It's the same exact type of numbers. Okay. And a lot of realtors just take this 5 cap deal, say, hey, Mr. Investor, Mrs. Investor, I have this off-market deal. They're looking for a 5 cap, but it's a 20 some odd unit, whatever it is, right? Like you're bringing this deal and the investors be like, how the hell can I make sense of buying this? And they're like, but like, you got to make an offer because it's an off-market deal. And blah, blah, blah. Like, it's not a good deal. Numbers don't add up. And again, if you're wondering how to do more business, you need to find deals that make sense. And if you're saying like, well, all these sellers want too much money, it means you haven't spoken to enough, to enough leads. That's really it. There's not a secret sauce here. Who's got another question?
With the spreadsheet, obviously multifamily is like an obvious one, but what other properties can you evaluate this? Because I feel like with retail it'd be a little bit different, would it not?
I mean, slightly, but not entirely. I've used this for office. I've used this for retail. I've used this for industrial. I've used this for multifamily.
What would the difference be with industrial? Because I really don't know a lot about that property type.
You just have to play with the numbers. So as an example, like I'll plug in all the actual expenses. The payroll, repairs and maintenance and reserves is not going to be based off of the unit, right? Like you're going to have to ballpark that based off of, what a bank is going to tell you. How much would you allocate percentage wise for these? Maybe you could do a freaking, well, you probably can do, and again, I'm ballparking here, but you could probably take the square footage of the warehouse. So like, let's just say a warehouse is 10,000 square feet and you can probably divide that by 1,000. Okay. And that will give you 10. So you can just plug in the number 10 here. And then that'll give you payroll, repairs and maintenance. And like, that'll probably give you the best thing. And then for units, I would probably double the amount of units in a retail space. So if you have a 5-unit strip center, I'd probably double it and say 10, because then this is all going to be pretty accurate. For office space, I would probably do the square footage thing again, where it's like, okay, well, if it's a 20,000 square foot office building, I would probably divide that by 1,000 or 1,000 or 2,000, and then you can come up with these types of numbers. Any other questions?
Yeah, Henry, on what you showed us, you did a breakdown on that particular project. You did a breakdown at the bottom with regard to owner financing.
Yep.
In the sheet that's on the Facebook page, and maybe I've got the wrong one, but it doesn't have that.
Yeah, I updated this one recently, so I will download this as an Excel sheet and I will send this over.
Thank you.
Any other questions?
The Facebook group you're talking about, it's just your personal Facebook, right? Henry Eisenstein.
No, so there's a Facebook group that, again, if you're not added us, if you don't have us added as a friend, we can't add you
Okay.
into the group, but it's
What's the name?
Facebook group. The Millionaires Club Facebook group, which again, we would add you in if you have to add us as a friend first, and then you should be in there. A big thing I just want to continue to stress this because I like, again, it's probably what's going to hold up a lot of you guys from doing a lot of business this year, which is if they are not willing to sell at a good cap rate, right? Like if a seller is not looking to sell at a good cap rate, which means just similar as to like Mustafa as your deal, right? With someone who's looking to sell for 5, 6, whatever it is, right? That's just not where the market is right now. And you need to just move on. And that is totally okay. It's a long-term nurture of a lead. And I'm just going to go find people who actually want to sell their property at a good price. And, it's like, what else am I really going to do about it? If they don't want to, it's just like a residential homeowner who's got a property where the market value is 500,000. They want to list it for 700. I'm probably not going to list that property for sale just because I don't want to waste my time. And like, I just don't need to spend an extra $300 to $500 for absolutely no reason. Just because I want a listing, like what the hell is the point? I'm going to take photos and spend all my time, energy, and effort trying to sell and have a client who's mad at me because I listed their property at 700 when it's never going to sell at 700. Like, it's just not worth my time. So again, it's about finding great opportunities, both on the residential side and the commercial side. Great properties at great prices. That's what people want right now. Great properties at great prices. Who's got any other questions for me? Again, like I want to, this is our bonus session, so I'm going to let you guys kind of drive the bus a little bit. So if there's anything you guys want to specifically talk about, don't hold back.
Yeah, I got one. I'm kind of curious your views on how traditional brokerages are going to make it, because this is kind of just what my friend says. He's in Tucson doing commercial with the traditional brokerage route. I think we talked about him, but most of his clients are like users. It's pretty much just a parallel to residential. It's just on the commercial side of things. And like, that's all he knows. But when he hears my experience, he's like, yeah, finding investors is like impossible, dime a dozen. And that's not like the way to make money, So I mean, obviously you're more successful, clearly. So I'm just curious what you think of that route and how they're going to even survive in times like these.
Yeah. So like, look, I believe truthfully and honestly that any realtor, I don't care about brokerages, but like any realtor in general, you can say, brokerages are like, the upper echelon of just large real estate teams. I mean, essentially, right? Any person in this industry, okay, companies and teams and solo agents all alike. If you do not shift in the way you do business, like I was speaking to somebody who their entire brokerage, okay, they're at a brokerage, their entire office, the entire brokerage itself specializes in office leasing. If you could specialize in any type of asset class, the last on my list would be office leasing. Their entire brokerage, hundreds of agents across 2 or 3 different offices, okay, is built off of the office leasing market. The office leasing market right now is horrible. And by the way, listen, there's some industries right now that are really struggling. Like as in like asset class, and I'm saying that as an industry, right? I'm saying the office industry, right? Like the retail market industry, if you're just doing leasing on the retail side, it's not easy right now. There's I look at it like this. I'm not the smartest guy in the world, okay? If you and I if all of us work together, we're all working at the same company. We're on a team together. We're all the CEO, okay? We all share the title of CEO. We're all working together, okay? No one's voice means any more than the other. If we're just talking and we're saying, okay, right now in 2023, given the state of the economy, and if we had to focus on one type of asset class, maybe two, one type of asset class, ideally, in one specific area, like all of you are in different states here, right? Some are in the same state, but whatever. We're all in different states. In your specific state, in this economic time, with your complete choice of asset class, regardless of what your actual history and knowledge base is, okay? What asset class in your area is blowing up right now?
Multifamily and industrial.
Okay, awesome. Guess what? I'm hearing that all across the fucking country. On top of the fact that residential deals are doing good if you can find right price stuff, right? just on commercial for a second. I just like to follow the wave. It's like we know what the history, like we know what the future is going to look like. We see it. It's like clear as day. Okay. And by the way, in your market, it might be multifamily more than industrial, and some other markets are industrial more than multifamily. I mean, everyone's market is slightly different. It's just being cognizant of that and then riding the fucking wave. It's like if you knew a stock was going to go up. That's exactly what this is right now. I know that X stock, multifamily stock, is going to go up. I know that industrial stock is going to go up in value. So if I had a bet on any stock, I would bet on that and just cold call that and find investors in those asset classes. Instead of saying, well, my brokerage has done it this way for the past 100 years, and that's what we're going to do. Well, that's dumb. It's just really stupid. Because by the way, if multifamily was doing terribly, why would I focus on it? But if it's doing great and a lot of people are looking for that type of product, I would probably want to spend more time focusing on that product. It's like in the residential world. If you know for a fact that first-time home buyers, we're just stating facts. This is not opinion. If you knew for a fact in this day and age, right now in this economic time, first-time home buyers, just like first-time investors, first-time home buyers are getting freaking crushed right now. The first-time home buyer market is just getting shellacked, which means that like there's, by the way, there's a huge pro in the first-time home buyer market, and there's a huge cons. Huge pro is that if you're prospecting for deals right now in the first-time home buyer market, you're probably selling properties faster than you've ever seen property sell. Okay, like if you have an entry price point residential single-family house, in the first-time home buyer price point, there's like too many buyers to even count. Right? There's still an insurmountable amount of buyers out there looking for product, and they're fighting over it. However, the huge con is if you're on the buyer side, you're probably still struggling to put a deal together on the single family house market. Now, if you know that certain price points in the residential, single family house side, as well as certain range of properties in the commercial world are selling more often than any other type of asset class, why would you not just focus on that? I like to ride the wave of wherever the economy is. If the economy is residential, certain residential areas or residential price points, right? Like in this economic time, if you're a luxury realtor, you're feeling the pain because most of the very, very wealthy people are not buying properties right now. Right below the luxury price point, if luxury hypothetically in your area is 2 to 5 million, right? I'd probably say between the 800 and 1.5 million range is probably doing okay. If you have decently priced stuff. In the commercial world, again, if you don't have decently priced stuff, something like a 7, 8, or 9 cap right now, day one, are you going to sell it? Probably freaking not. So I'd like to ride the wave wherever the economic cycle is. And if right now the economic cycle is X, I'm chasing X like crazy. I'm riding the X wave.
And just to kind of to my 2 cents, I guess, I was actually focusing on a lot of office and a lot more on retail, and both of these are not moving in our area, and I was just feeling like the whole market is shutting down and nobody's selling. There is no activity. However, as soon as I started prospecting industrial and multifamily, it's crazy over there. So it's like you're literally going to the greener side, or like you're going from an area where it's dead to an area that is very busy. And that's 100%. Just my 2 cents in how I felt about changing.
I appreciate you sharing that, because guess what? There's a lot of people who are saying the same thing to me. There's no transactions in my area. What freaking asset class are you looking at? Don't get me wrong. I agree 100%. There is less transactions going on. That is just a fact. There is less transactions going on now than there ever has been in history. However, there are still certain asset classes that are doing well. Not doing great, but doing well. And I can ride the doing well wave all day long because I'll generate opportunities, leads. Okay, I'll generate opportunities in that class, in that specific asset class, whether it's residential or it's commercial. I will generate opportunities in that asset class, and I will find people who want to sell for good prices, because there will always be a buyer for good properties at good prices. There will always be a buyer.
So a lot of gurus say to specialize, but obviously at this point, hearing what you're saying, that would probably actually just kill your opportunity if you only specialize and were, stubborn about it.
If you specialize in the wrong asset class, it will put you out of business. If you specialize in the right asset class, it can make you a millionaire.
And Braden, maybe I also do listen to a lot of people that do say, specialize in one thing and focus on that one thing. And that one thing doesn't have to be the asset class. It could be real estate. Like instead of moving away from real estate, like instead of, let's say, if you need to make $4,000 in the next 3 months or whatever, or $10,000, instead of you spending that time to, let's say, work a second job or do Uber or start another business that you think will be very fast, very lucrative fast, you might as well spend that time in real estate, and what it takes in real estate to make that money. So like going through like 99 no's to get 1 yes, it's worth it. You're not really. There's always progress. It's not like you're dying or you're not doing anything, as long as you're calling and doing what it takes. and the activities. This is my third business, and honestly, it's the most business that has like input and output. Like you do this much work, you'll get this much out of it. Now, market does get harder, so you have to put more work into it. But at the end of the day, you're still leaving with the same amount of output if you know what input you need to put in there.
It is directly correlated to your output. I mean, it's directly correlated to the activities you're making every day. It is just like most sales jobs. However, it's like right now, as an example, again, if you were cold calling office buildings versus cold calling multifamily apartments, right? Or industrial properties, the return on your activity investment is going to be very different. So yeah, I agree. Specialize in one for now. And then guess what? If hypothetically, okay, because I don't know, I think it was like early 2000s, the office market and the retail market were on fucking fire. They were crushing it, right? It's just like the industrial and multifamily market right now. Okay. So guess what? If I was doing business in the early 2000s, I would probably have been calling office buildings and retail buildings like crazy because the multifamily wasn't the huge thing then, but now it is. So I'm going to call it. Same thing with industrial. Everyone's interested in it, so I'm going to keep calling it. Who else has got questions for me?
Just real quick, your contact for your list of calls. Again, my brain, I'm having to switch it over, so everything's 4 units or less up until now. For those that are larger, you said there's software that has that. So like Mojo has it for, I can get residential for my whole world, but
yep.
But what do you use? What would you recommend we use to get the lists of the daily calls for the multifamily commercial?
CoStar and Reonomy. Those are the two places that I buy it. Again, Reonomy is probably the best place to start. CoStar is the best, but I would say Reonomy is the good place to start. CoStar is also insanely expensive.
CREsync has lists for both, by the way, and they're a little bit cheaper, but you have to.
The only reason why I don't say CREsync is because you have a very small amount of data you can pull at any point in time.
Yeah, because they make you like export the list, so it's not super convenient, but that's another option.
Yeah, you can do CREsync, but again, I think it's like 250 per month. When Reonomy, I think, is 7,000 per month or 5,000 per month.
Reonomy, 5,000 a month.
So yeah, Reonomy, I think you can really.
Oh, the exports, yeah.
Yeah, the exports, and the same CoStar is something similar to that. Like I think CoStar might only be 2,000 per month or 3,000 a month. I forgot what the number is, but like.
And it gets real specific. I'm assuming I can narrow it down to all the different filters.
It is quite specific.
Yeah, skip tracing these LLCs. I know we talked about you use batch, but I'm using batch and it's like the worst data ever. It's like 20% hit rate probably.
It's like the golden goose that we're all after. You know what I mean? It's like the information that everyone's trying to figure out how to do it the best. Can you cross-reference with Reonomy and CoStar and then cross-reference through batch and then do it through PropStream and then through 3 or 4 other softwares? Sure. The best way that I've ever seen that someone has ever gotten data is actually having relationships with at the tax assessor's offices and things like that, where you can actually pull the actual owners of LLCs and stuff like that. It is a freaking process. Is that probably the best way to do it? Sure. And probably the most time intensive and the most costly, but you will get probably the best leads. It's going to cost you a fortune to try to get the right data. Which is listen, I'm going to be honest, I've done everything that I've done so far has been off of CoStar, Reonomy, and batch leads. That's just everything that I've personally used. Have I also used PropStream? Sure. Just, it's been less recently. Data is king. Wherever you guys can get the best information is incredibly important. And at the same time, it's just whatever you can get your hands on, just know that it's still a law of averages. Whether you can still pull all the data from the LLCs and all the the true owners and everything, it's still a law of averages. I still get a lot of hangups. I still get a lot of wrong phone numbers. I still have all the same things that you guys do.
I got one more question. Probably got to head out after that. I saw on your Instagram you were talking about, following the ebbs and flows of the market, but you mentioned that in regards to commercial and residential. I was kind of wanting more information on that. Did you mean in certain market conditions you do mainly residential and vice versa?
Sometimes. Listen. Personally, I have a team set up that does residential. So it's not me personally, but again, if I'm a solo agent and in this economy right now, think about it. You guys every single one of us on this phone only have so much time in our day. We only have so much time to prospect certain stuff, right? We only have the same 24 hours a day. So if you're going to spend any time of your day prospecting, I would be prospecting for things that are moving. So right now in this economic time, I'd probably spend maybe 20 to 30 or 40% of my time prospecting residential single family properties in certain areas that are moving. And the other 40, 50, 60% on commercial asset classes that are moving, right? So it's like, anything that is moving, I'm going to spend time on. And listen, does residential deals close often quicker than commercial deals? Yes, it does. So would I spend 100% of my time in the commercial world? If I already do both, probably not. I'd spend a little bit of, I'd spend a percentage in each, and that's okay. I just personally don't do that because I don't want to, and I'm in a little bit different of a place. But like, again, if I'm a solo agent and super reliant on making a couple bucks this month, I would probably spend maybe 30 or 40% of my time in resi and and the rest in commercial, or vice versa. Like if your entire business is residential right now, like Nate, as an example, again, just to quickly touch on, like, I know you're transitioning, quote unquote, through from residential to the commercial world. I would probably spend the opposite. I'd probably do 60% of my time or 70% of my time in the residential world, because that's where your money is, and that's what and that's like, I would totally not. The biggest mistake I see people make is like, they're a residential realtor and they're like, all right, I'm gonna go in commercial, and they just go 100% in commercial leads, and they're like, I haven't made money in 7 months. I'm like, fucking duh. I mean, like, because you got to build a pipeline, right? You have to build a long-term pipeline. It might take you, Nate, 6, 7, 8 months to close your first commercial deal if you start prospecting today. That's why, like, I would probably spend maybe 20-ish% of your time in the commercial and 80% of the time in residential, and it's slowly, as like things start building up on the other side, you can slowly start curving over to the more commercial, then a little bit less residential. I would 100% not just switch.
Yeah, that makes a lot more sense. I'm starting to understand the amoeba mindset that you have, so I appreciate that.
The amoeba mindset's right.
Yeah.
I have one question to tag on that. If we spend time, I guess maybe it's going to sound stupid, but if we're spending time prospecting, I heard somebody say when it comes to absentee owners, now I'm back, I guess, to single family, but when you're tracking those folks, is it possible to, like, do you have to see a property? Because I know you said you handle well, now you're multi-state, but you originally were all of New Jersey or whatever. Do you have to see the property to be able to give them an offer and make something happen on it, or can you do it from a distance, remote?
Majority of what I do is remote. Again, like, listen, I live in New Jersey. I'm debating on maybe moving soon, but I live in New Jersey. Most of the deals are in New Jersey. However, do you, like, think about it openly? Do you need to see a property to make an offer? You don't need to. I mean, would it make things a little easier? Probably, to understand condition. But instead, what I do is that I have agents who work for me, and they go to the property. They take pictures, and I look at the pictures or a video, and based on that, we come up with a number. And for the most part, my intention is also, like, if I'm calling absentee owners as an example, or residential single family houses, and I'm talking to an owner and they want to sell the property, and on the residential side, then you're gonna be like, okay, would you be totally against listing the property for sale? And if they say no, I mean, I guess I would be open, set up a listing appointment and go conduct the appointment, obviously, right? However, if it's a little bit larger of a property, and it's a commercial deal, like, I don't really need to go tour a 10-unit property to give them a value. You know what I mean? Like, I could, because commercial is 100% based off of an income for the most part, or at least 98% of the value is based off of current income. It's like, why I don't need to go see that property. I just need to know what the income is. Even if it's residential, I don't want to list it. Like, I'd be like, okay, can you give me like a rough condition? Have you done any renovations in the last 6 to 12 months? Do you have any photos you can send me? Right, this way I can give you a quick number, or I'm gonna, or would you be totally against me stopping by and taking a look and just treating it like that? Next week we obviously have a session. I just want to make sure, like, if there's any other specific topics or any other specific items you want us to be diving into each and every single week, just to bring more value to you guys, or anything you'd like to see, make sure you guys let me know. Because we're gonna be not changing up everything, but I want to be adding things to this as often as possible, just to make sure we provide as much value to you guys. So if you guys have any cool ideas or anything like that, feel free to share it with us. And again, I like the breakdown of the phone call we did with Mustafa. I can definitely do more of that. I know that we can do, like, again, if you guys have a lot of leads or deals you want me to underwrite, I can do underwriting live with you guys here. So there's no limits here of what we can really try to have offered during these sessions. So keep that in mind. All right, guys, I hope you all have a fantastic week. I'll see you guys next week. See you later.
If you're still watching this video, that means to me that you're a committed real estate agent and you're looking to take your life and business to the next level. I'm just curious, why have you yet to schedule your free, no obligation coaching consultation? All you have to do is simply go in the description down below, and people are telling me this call has been the most unbelievable, the most powerful call they've had in their entire career. And here's just a few of the individuals who have taken full advantage of this call. And my mission is to support as many realtors years as possible. Build a 6- and 7-figure net income business so that they don't have to rely on this industry anymore for their everyday income. If you're a committed realtor, which I can see like you are, all you have to simply do to take full advantage of this free coaching consultation is to go in the description down below and schedule your free call now.